Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern. Every Monday morning, get you ready for the week. Stocks to watch, economic news that could guide the market. Very important topic this week. Stocks did fall on Friday. Jitters coming up as the signs of a delay in that debt ceiling negotiations. Still, though, despite this, the odds of some kind of a pre-default deal are still very much the consensus in the markets just because of how bad a default would be on the economy. Unfortunately, the debt limit is probably the least of the market's worries right now. Okay, in fact, there are two events that I'm going to talk about right now that are even worse, and both definitely going to happen over the next few months. So we're going to talk about that, talk about why those are so bad and how it could affect the economy. Stick around after that, though. We're going to get into our market update, stocks to watch this week, economic news that could guide the market. Before that, though, all you out there in the Bowtie Nation know I've been sitting on a chunk of cash in my account just waiting for the stock market to give us that all clear signal over the last couple of months. It's saved me from a lot of those bear market rallies that have sent stocks lower, but it sucks just having it sit there earning no return in my E-Trade account. So instead of locking up my money in a bond or risky early withdrawal fees with a traditional CD, I found a no penalty CD from CIT Bank, and I'm now earning interest while I wait. I'm going to leave a link to that in the description below. Make sure you check that out because this is a great way to earn a higher yield on your cash instead of just sitting around in your account. All your money is FDIC insured and it compounds interest every day at that 4.1% return. Unlike traditional CDs here, there are no penalties to withdraw, and you have 24/7 access to your money for that CIT Bank mobile app. Withdraw it, put it back in stocks anytime you want. I want to get back to that main topic though, because this does have the potential to send stocks significantly lower. Two events that are definitely going to happen over the next several months, and nobody is talking about it right now. And first could be a $500 billion shock to the monetary system following any debt deal we get. This shows the balance on the Treasury's general account. So think of this as like the government's checkbook. Anything the government has to pay out, Social Security benefits, all that, it comes out of this general account. This has fallen to just $95 billion, and it's expected to fall even further, almost to zero by June, towards that X date for the default. Now, with a debt limit deal, the Treasury is going to need to rush to refill this account so it can continue to pay those bills. And there are estimates that it could increase this account to $550 billion in just 1 month. And how it does this is the important part. Okay, how it does this is by selling Treasury bills. Okay, so those Treasury bond investments that investors can buy, that banks can invest in. Anyone that wants a super safe, backed by the U.S. government Treasury bill that earns that interest rate return on it, they pay cash for those bonds. Okay, so they issue those bonds backed by the government, and take in cash. That cash refills that general account that they can use to pay for those Social Security benefits and everything else. Now, that cash here is probably going to mostly come from banks, other large institutions, right? Mom and pop there aren't investing $550 billion in 1 month in Treasury bills, right? So this is going to be coming from banks, other institutions, corporations, draining the amount they have available to make out loans and invest in capital projects. Okay, so think about that. That's like a reverse stimulus. In 1 month, the U.S. government is going to be taking out $500 billion in cash, $550 billion in cash coming out of the system, invested in Treasury bills to sit in that account. And in fact, Bank of America estimates this could have the same impact as another 1/4 point increase in interest rates. That's the first event, and that's going to start as soon as we get any kind of debt limit deal. So just as the market is at peak enthusiasm that, hey, we didn't default on our debt, it's going to be hit by this reverse stimulus that's going to take money out of the system. The next one, though, Education Secretary Cardona has confirmed that the government is preparing to restart student loan payments no later than 60 days after June 30th. Okay, payments have been paused since March 2020, and while the U.S. Supreme Court still has to decide on the legality of Biden's forgiveness program, millions of Americans are going to have to start repaying their loans in just a few months. And if you just think through this, doing some quick back-of-the-envelope math, you see how this could really hit consumer spending and really hit the economy over the next few months. Again, more than 40 million Americans owe student loans, and before that forbearance, they were paying an average of $200 a month on loans for associate's degrees, all the way up to $460 a month on average for those loans with master's degrees associates. Since March 2020, more than 25 million of those borrowers have chosen to hold off on payments. So 25 million Americans not paying for almost 3 years, more than 3 years on their student loans. That's going to end. They're going to have to restart paying those in just the next few months. And the problem here is that most of those borrowers have found other ways in which to spend their money. Okay, household debt has ballooned to $17 trillion as of the first quarter, with non-housing debt reaching almost $4.7 trillion. Okay, credit card balances were almost $1 trillion last quarter. Car loans jumped by $10 billion in just those 3 months. So in that 3 years, since student loan borrowers have not had to make their payments, they've forgotten how that a payment affects their budgets, and it could mean a shock to the economy when those payments return. And we won't know the exact effect of this until we actually see it restart. There is some talk of kind of a staggered restart where a certain number of Americans are going to have to start repaying their student loans at first, then that's followed by another tranche and another group. So maybe a little bit staggered there. But just on a conservative estimate of 20 million borrowers restarting an average of $300 a month payment, it would drain at least $6 billion a month out of consumer spending. Because obviously, if they're repaying their student loans, they can't spend it on all the other stuff that they've found to bust their budgets over the last 3 years. That's at least a 0.5% hit to consumer spending at a time when consumer spending is all the economy has holding its up. Okay, it's likely to be much worse. That sudden strain on budgets is going to drive up default rates on other loans. It's going to increase interest rates on those consumer loans, pile up the late fees. All of this is just going to come together to have consumers tightening their spending even further. The economy is already slowing. It could be the turning point into a recession. So how I'm investing on this, while I did reduce some of my portfolio cash back in March, took advantage of the sell-off in late February, early March, reinvested in some of my favorite stocks and took advantage of that, it might be time to take some profits and really protect a little bit more as the market adjusts to these realities coming over the next few months. I think the market could breathe a collective sigh of relief when we do get some kind of a debt limit resolution. Obviously we're not going to default, so the market's going to see that, but that's going to be the high point before a months-long sell-off as it gets into these student loan repayments, as it hits this Treasury cliff that we're looking at. So what I'm going to do, I'm going to increase my cash a little bit, maybe put it a little bit more into that CIT no penalty CD there, earning that 4.1%. Wait for the market to adjust to these and buy in at a later time. Some of the stocks I'm watching this week going to be a big week for the smaller retailers. Okay, they're going to have an important week following the really poor earnings from the big box retailers like Target and Walmart last week, as well as a massive 27% sell-off on shares of Foot Locker on Friday. The big box stores, Target, Walmart, only barely beat their expectations on earnings, but showed really a weakening consumer, while Foot Locker missed its sales and earnings by a wide margin. Okay, the athletic retailer also said sales this year were going to fall more than previously forecast. Now they're saying sales could be down as much as 8% on that weakening economy, just lower consumer spending. If this is echoed by a lot of these other retailers that we see earnings from this week, it will be a big headwind for stocks as that consumer spending accounts for 2/3 of the economy. I'm also watching UiPath, ticker PATH. It's going to be reporting its earnings on Wednesday. Stock really benefiting from that boom in AI stocks, the enthusiasm for AI. Stock is up 26% this year so far and is expected to report 18% sales growth to $1.25 billion this year. Shares are actually relatively attractive here at just 7 times on a price to revenue basis. So a lot of these AI themed stocks are getting extremely expensive in that kind of AI bubble that everyone's talking about. But here, UiPath, I'm kind of surprised at how cheap this stock is. On any optimism for AI could send these shares higher when company reports there on Wednesday. VMware, ticker VMW, also going to be reporting its earnings on Thursday here this week, with shares really kind of stuck in limbo on a planned $61 billion acquisition by Broadcom. Okay, regulators in the EU as well as the UK have warned that this could lead to higher prices, lower competition for business customers, so they're investigating that. They've extended the deadline to rule on that merger to July 17th. Obviously, this has caused VMware and Broadcom to extend their talks to be able to get this through regulatory approval. Shares of VMW are now trading 15% below that offer price. You see here it's trading for about $54 billion market cap, under that $61 billion acquisition deal. This is typical for acquisitions, right? Until they receive, full regulatory approval, until they are guaranteed to go through, they will trade at a discount to the acquisition price. And of course, investors in that are hoping that goes through and they get that quick bump up in the shares. Even without that, though, this stock is attractively priced on just expected earnings, and it could be a win-win situation for investors. Earnings are expected to $7.25 a share this year, to grow 12% this year, 12% next year on 7% sales growth. So that's a solid double-digit return either way on this stock. We did see that 7 of the 11 stock sectors closed higher last week, with those cyclical kind of growthy stocks in technology and communication services really leading the way. While interesting here was that interest rate related stocks tumbled. Okay, we did see that the 10-year Treasury bond, the rate on that went up from just 3.4% to 3.7%. That really weighed on stocks that pay dividends, that have a higher yield, like utilities, real estate, and consumer staples. Okay, when that happens, when that jump in rates goes up, it really draws those yield-searching investors away from these dividend-paying sectors. Utilities, consumer staples, and real estate draws them out of those into bonds because they can now get those higher interest rates. Now, what I'm thinking here is any progress towards an agreement on the debt limit is likely going to continue to push up those long-term interest rates, because investors aren't going to be worried about a default. They're going to be maybe a little bit more enthusiastic, positive on the economy. That's going to push up those interest rates and continue to weigh on stocks within these 3 sectors. Limited economic data coming out this week until Friday. What I think could be the big news this week is we have 6 members of the Federal Reserve are scheduled to give speeches this week. It's notable because lately the Fed has gone out of its way in interviews to really start that warning that the market needs to be baking in maybe further rate increases to continue. Okay, several members came out last week, including Chairman Powell, saying that inflation was still persistently high, not high enough to really be pausing or cutting rates. Chair Powell brought up the idea of a pause, where maybe in the June meeting they might pause and hold interest rates where they were, but still left the door open for further rate increases. Okay, right now the market is pricing in the likelihood or the probability that rates stop increasing and actually start decreasing by November. Okay, so what the Fed is saying, it's trying to get investors ready for the fact that if inflation doesn't fall, then we could still see higher rates, which would obviously be weighing on stocks. They don't want that to be too much of a surprise to investors when that finally happens. So they're starting to talk that up. We're going to hear a lot more of that by those 6 members of the Fed this week, and I think it could kind of put a weight on the market as investors realize that, yes, the Fed is serious about continuing to increase interest rates. Check out that high-yield, no-penalty CD from CIT Bank with the link below, or click on the video to the right for the 7 stocks that will pay your mortgage. 7 high-dividend stocks to put a roof over your head. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.